Hi everybody, I'm Brittany Lewis, a breaking news reporter here at Forbes. Joining me now is Michael Pearce, Deputy Chief U.S Economist at Oxford Economics. Michael, thank you so much for joining me.
Pleasure to be here.
I would love to get your perspective on the tariff whiplash we have witnessed over the past week and a half. Global markets melted down after President Trump unveiled his sweeping tariff policy on what he dubbed Liberation Day. Then this week, he did announce a 90-day pause on those reciprocal tariffs. At the same time, he did also announce that he was ratcheting up the United States' trade war with China. What do you make of the events that have unfolded over the past couple of days as they relate to tariffs?
Yeah, it's difficult to keep pace with all the announcements, but I think, if you focus on where we've ended up, I think one approach is to just look at how the tariff rates shake out as an average across all the products and across all countries. And when we do that, we estimate that the average tariff rate that the US is facing is still set to rise to something like 25%, which is more or less what we calculated straight after April 2nd and before we had this retaliation with China. So this is still a very significant ratcheting up of tariffs. It would take the average tariff to its highest rate that we've seen since the 1910s. So this is worse, still looks worse than the 1930s, the famous Smoot-Hawley tariffs during the Great Depression. And it's a very big change from the 2.5% tariff rate we have coming into this, in an order of magnitude bigger than we saw in Trump's first term.
That's really scary to hear an economist saying that these tariffs are still, despite the pause, still higher than pre-Great Depression tariffs. What does that mean for the American consumer?
Well, I think it's quite uncertain. I think the tariffs themselves are very clearly going to have a hit to consumers' real incomes. So, tariffs are a tax hike. They will mostly fall on final consumers here in the US. We've calculated a 25% average tariff rate would feed through to something like a 1.5 percentage point increase in the level of consumer prices. So we're talking about inflation rising from what we've got at the minute, which is close to 2.5% to something like 4% by the middle of this year. So you're going to see that wave of inflation hit as firms are forced to pass through some of the impact of these tariffs, and that's really going to mean households have less to spend on other goods and services. But I think the key point here is it's no longer just about the tariffs, it's the uncertainty and the financial market disruption we've seen as a result of these policies being rolled out that's also going to have an impact. So I see the US economy almost being faced with 4 separate shocks at the moment. You've got the tariffs themselves, which are going to hit people's real incomes. We've also had a huge decline in consumer confidence, so a big confidence shock to the economy. We've already seen that play out. The sentiment data is, we got data for early April, and it was the worst, almost the worst on record. So I think you already see signs that consumers are beginning to pull back. They're feeling less certain about their prospects in the labour market. And I think on top of that, the turmoil in financial markets is going to have real impacts as well. Businesses are facing rising borrowing costs. Households' portfolios have gone down a lot in value, so there's just less certainty out there, and the risk for the economy and ultimately for consumers is that this spirals into firms beginning to lay workers off just because of the uncertainty and because they're unable to access credit.
In my conversations about the tariffs, the theme that I consistently keep hearing is uncertainty is the worst thing for the economy, uncertainty is the worst thing for businesses. How do we get back to certainty, or is this uncertainty, this volatility, is that the new rules of the road?
Well, I think there's always uncertainty in the economy. If you're a business leader, you're always making decisions without knowing what the future's going to hold. But I do think what we're seeing today is quite extreme levels of uncertainty. And if you think about these tariffs, the uncertainty that they create, the whole, I think one of the ideas of these tariffs is to help bring back manufacturing to the United States. But if you're a business in the United States planning today and you're looking at investing a large amount in equipment, in plants to build these goods in America, those are investments that have a payoff, they pay off over 10, 15 years. You can't base those investment decisions on a tariff policy, which you don't know if it's going to still be in place in 4 years, but at the minute you don't even know if it's going to be in place in 4 days' time. So you just don't have that long-term certainty that you need to make those investments.
You and I talked about a month ago about the tariffs when it came to Canada, Mexico, and China. And we talked about if tariffs were a bad policy or the art of the deal. And some supporters of these tariffs are saying, hey, this is the art of the deal. Trump was willing to wreak havoc on global markets to make all other countries come to him and negotiate for fair trade in America. Others have said he tanked the economy really for no reason, and he caved at the market's reaction. What do you make sense of this moment? How do you square that? And is there a good reason to inject this type of volatility to, what he said, make American trade more fair?
Well, I think we've never really got clarity on exactly what these tariffs are intended to do. You can think of 4 possible reasons. This is just a negotiating tactic. It's to raise revenues so that we can pay for tax cuts on incomes. This could be all about national defense. We need to reshore production to ensure our national survival in the case of a war with China, for example. Or it could just be about restoring fairness to perceived unfair trade practices from other partners. And it can't really be all 4 at the same time. And I think what you see, the consistent pattern is that there is always a negotiation element when it comes to this president, and we see that some of these countries coming forward with some of these offers for negotiations. But the history of trade negotiations is that these are very long and drawn out processes. It's not going to be easy to come away with any quick wins, just because these countries have their own domestic priorities, and most of the remaining trade barriers are, quite frankly, in areas where it's very difficult to overcome those barriers. It's about things like trade in food, trade in healthcare. Very sensitive areas where there's a lot of overlapping domestic priorities as well. So I think it will be very difficult to extract any meaningful concessions out of these countries, at least in a very short time horizon.
Let's talk about that a little more. I am curious about how the rest of the globe is viewing America at this moment. Are they viewing President Trump and his tariff policies as essentially the boy who cried wolf, because he's paused them now, he's paused them before, and they were only in effect the reciprocal tariffs for a short amount of time? Or do they see this as real leverage here, that he is willing to go to the brink and beyond?
Well, I think a lot of countries are still facing much higher tariffs now than they were before. You still have this 10% baseline tariff in place for the rest of the world. So this is a very large change with the trading relationship with the U.S. And so a lot of countries are very eager to get out of these tariffs, but it's unclear what they can provide in return for relief on these tariffs. And there's been countries that have tried a variety of approaches, and in the end, pretty much every country's ended up with a similar tariff rate. So doesn't seem like there's a clear way for countries to navigate this. So I think the main reaction is just this realization that the United States is a less dependable ally in this world, and to seek relationships elsewhere where they can trade and get a bit more certainty.
I mean, that's not a good outlook, to view the United States as a less dependable ally. Long term, what do you think that this does to our global trading partnerships?
Well, I think it's a clear step away from globalization for the United States. I think 10, 15 years from now, the US probably imports a lot less from the rest of the world relative to its overall economy. But at the same time, I think you'll see the US exporting a lot less as well. Normally the lessons of these of tariffs is that they don't really change trade balances much, because you simply get fewer exports because the dollar will appreciate. You'll get retaliation from other countries. So it's about making the US more self-sufficient as a country. My view is that doesn't really help boost the overall amount of production going on in the United States. It more or less shifts things around. So there's winners and losers. If you're producing goods that compete with imports at the moment, those are industries that are relative winners in today's economy. But if you're a large export-focused firm, say the Boeings of the world, a lot of farmers in the United States. I think there's going to be a lot of pain because a lot of those export markets are going to be shut off or diminished over the coming years.
When you're framing it like winners and losers, are there more winners or losers in America when it comes to these tariff policies?
Well, I think the tariff policies on net are a negative because they create this loss of efficiency. We're going to be forced to produce more of the things that we're not as good at producing, and the things that the U.S. is very globally competitive at. There's going to be reduced export markets for those goods. And so, when you frame it that way, we're kind of hamstringing our most successful industries to promote ones where we are less competitive. So overall, I think it's a negative. But I think the main thing is that in the short run, the uncertainty and the kind of a lot of these transitions will be very painful. So in the near term, it's a lot of pain, and in the long term, I think it's a net negative.
In this tariff chaos, it does seem like President Trump is trying to isolate China, because in the same breath that he announced the reciprocal tariff pause, he announced that he is escalating that trade war with China. He said in a post 125%. The White House then clarified it's actually 145%. China retaliated with tariffs of their own. What do you think about this escalating trade war between the U.S. and China, because they are the world's two biggest economies?
Well, I don't think tariffs can remain at this high levels for very long, and if they do, then we're going to see a lot of that activity shift. So what we saw in the first trade war was when you had very relatively high tariffs on China versus the rest of the world. What happened was a lot of those imports ended up coming through other countries, and so I think that's what will happen today. You already see a lot of U.S. firms have already set up kind of a China plus one strategy. They have other manufacturing hubs in Asia. And so I think you'll see those firms still importing, but importing from these third countries rather than China. So the goods will find a way of getting out of China through these third countries and still making its way to the US. I think why I think the markets were a lot more worried about the tariffs that we saw after April 2nd is that a lot of those alternative manufacturing hubs also faced very large tariffs. So it was going to be a lot harder to get around those, and therefore that more firms would have to pay them. When you've got such a high rate on one country and lower rates on other countries, I think what you're going to see is a lot more of this strategies to get around it. It's going to be a lot easier for those firms to dodge those tariffs.
You said that you don't think that this is going to last forever or too long because those rates are so high. So who do you think then is going to cave first? Because China reportedly said something to the effect of, we're not going to come to the negotiating table under duress. So who's going to essentially balk?
I've given up trying to make predictions about future tariff rates. I think it's such a fluid situation. But I think, listen, it's clear that this will hurt both economies. So there is a mutual deal to be done here to de-escalate tensions. Whether that comes on the U.S. side or the China side, I'm not sure. But there's such a wide range of policy areas that there's always going to be give and take on both sides of the relationship.
I'm done asking people and economists about tariffs, specifically what they think is going to happen next. Actually, after that, because to your point, no one knows really what's going to happen next, and this is such an evolving situation. So I guess instead of that, what indicators are you looking out for between now and that 90-day pause end?
Well, I think, the first thing I always look at is, what do these tariffs mean for the overall average level of tariffs, and that's a number that's changing on a daily basis. So I keep an eye on that closely. But I think because we've had the shock that we've had to confidence, to financial markets, I think we also need to be keeping an eye on the markets themselves. So I'm looking at what's happening to the stock market, but also signs that this is spilling over to the bond market. We've seen a lot of signs of stress there, rising borrowing costs for firms as investors simply sell everything. I think that's a key transmission mechanism for how this could get a lot worse. And then the third is seeing where this actually, where the rubber hits the road for consumers and for firms, which is in looking for signs of layoffs. We've been in this economy for a while where hiring has slowed a long way, but we've had a very low level of layoffs in this economy. So any sign that the challenges in the financial markets, that these tariffs are beginning to cause real pain for businesses, I think what we need to look out for is signs that layoffs are beginning to pick up, and we'll see that first in the initial jobless claims data. They come out every week. They've been up slightly, but as soon as we see any spike there, I think that will be a sign that some of this downside risk that we're talking about to the economy is beginning to crystallize.
Well, there's certainly a lot to look out for. And Michael Pearce, I'm glad you came back in to break it down for us. I look forward to more of these conversations as the tariff situation continues to develop. Thank you so much for coming on in.
Thank you.